Good day, everyone. You're welcome to this week's Business and Investment Tips program, a production of RCCG Christ Church Radio with Dr. Ayodeji Ebo, an investment professional. This week, we focus on Nigeria's fourth quarter 2024 GDP report. Last week, the National Bureau of Statistics, NBS, published Nigeria's fourth quarter gross domestic product GDP numbers for 2024. The Nigerian economy recorded growth for the 17th consecutive quarter since emerging from a recession in 2020. Real GDP expanded by 3.84% year-on-year in Q4 2024, the fastest pace in 3 years. The improved growth rate in Q4 2024, October to December 2024, relative to the previous quarter, July to September 2024, was driven by a strong service sector performance, which has been the economy's backbone. Overall, Nigeria's GDP grew faster at 3.4% in 2024, relative to 2.7% in 2023. GDP is the key indicator of economic performance, measuring the total value of all final goods and services produced over a specific period, typically a quarter or a year. GDP provides a clearer view as it is adjusted for price changes. Ultimately, economic growth is about the increase in the quantity of goods and services produced rather than inflationary price fluctuations. Nigeria's GDP report captures 19 sectors with 5 heavy hitters accounting for 83.4% of the economy's total activities. These are financial services 23.7%, agriculture 21.2%, manufacturing 13.4%, trade, wholesale and retail 13.8%, and ICT 11.3%. The non-oil sector, which has been the primary driver of Nigeria's GDP growth since Q4 2020, accounted for 95.4% of GDP in Q4 2024, up from 94.4% in Q3 2024. The sector grew by 4% year-on-year in Q4 2024, up from 3.4% in Q3 2024. On the other hand, the oil sector growth nosedived to 1.5% year-on-year in Q4 2024, relative to 5.2% growth in Q3 2024, despite high crude oil production. Q4 2024, 1.54 million barrels per day versus Q3 2024, 1.47 million barrels per day. This moderation indicates the influence of a strong baseline from the same period last year, during which oil production averaged as 1.56 million barrels per day in Q4 2023. Broad-based expansion occurred across the structural sectors of the economy. Services recorded the strongest growth rate at 5.4% year-on-year in Q4 2024, marking the highest rate in the past 8 quarters. The industry sector's growth remained subdued at 2% in Q4 2024, relative to 2.2% in Q3 2024, while growth in the agriculture sector rebounded to 1.8% in Q4 2024 from 1.1% in Q3 2024. Based on sectoral contributions to GDP services, 57.4% in Q4 2024 versus 53.6% in Q3 2024 improved, while agriculture 55.6% in Q4 2024 versus 28.7% in Q3 2024, and industry 17% in Q4 2024 versus 17.8% in Q3 2024 both declined. In Q4 2024, the leading contributors by subsector to GDP growth were crop production 19.3%, trade 13.8%, telecommunications and information service 9.5%, construction 7.6%, and financial institutions 5.2%. Now, our key takeaways. 1. In Q4 2024, all 19 sectors experienced growth, although 6 of the 46 subsectors showed negative rates, showing that the economy remained resilient, although not operating at full capacity. 2. The oil sector's growth of 1.5% year-on-year in Q4 2024 falls short of Q4 2023's impressive 12.1%, owing to underinvestment and security issues. The production level of 1.54 million barrels per day is still far below 2.06 million barrels per day target indicated in the proposed federal government budget for 2025. 3. Growth in the agriculture sector slowed to 1.8% from 2.1% in Q4 2023, linked to to a weaker growth in crop production, which fell to 1.8% from 2.2% in the same quarter due to ongoing insecurity in farming areas and extensive flooding during the primary harvest season. 4. The ICT sector maintained its robust momentum with a 5.9% growth in Q4 2024, propelled by 6.8% expansion in the telecommunications and information services subsector. Despite declining active telephone subscribers during the quarter, increased data and voice subscriptions bolstered this growth, notwithstanding ongoing foreign exchange volatility and regulatory challenges. 5. The financial and insurance sectors sustained their growth form, although slightly weaker at 27.8% year-on-year in Q4 2024 compared to 29.8% in Q4 2023 and 30.8% in Q3 2024 due to the decline in financial institution growth to 28.4% in Q4 2024. The strong growth may be attributed to increased interest income following the CBN MPR hike of 8.75% in 2024. 6. In Q4 2024, the manufacturing GDP experienced an increase of 1.8% year-on-year, up from the modest 0.9% in Q3 2024, despite ongoing challenges impacting overall production. Remarkably, the oil refining sector rebounded with a growth rate of 9.6% year-on-year, in contrast to a decline of 32.4% in Q3 2024. This marked its first growth since Q1 2018, which is registered at 7.1% increase attributed to the commencement of operations at the Dangote refinery. 7. In Q4 2024, the trade sector saw a year-on-year increase of 1.2%, up from 0.7% in Q3 2024, yet it fell short of the 1.4% recorded in Q4 2023. Nevertheless, the depreciation of Naira during the quarter resulted in elevated import costs, which adversely affected trade activities. 8. Real estate sector growth improved slightly to 0.9% in Q4 2024 from 0.7% in Q3 2024, though the sector remains affected by high maintenance costs driven by the Naira depreciation. Looking ahead, the rebased GDP growth is projected to reach 4% in Q1 2025, supported by several factors. A. The oil sector's GDP is expected to rise due to diminished oil theft, lower pipeline vandalism, and the slow increase in oil investments enabled by the federal government's approval of key divestment deals between local and international oil firms, which will enhance production. B. The non-oil sector. A gradual increase in consumer demand stemming from easing inflation and a relatively stable Naira are expected to foster growth. However, high borrowing costs and ongoing low FDI could impede progress in the near term. C. Oil refining operations at the Dangote refinery and other government-owned refineries are set to support the growth of the manufacturing sector. D. On the other hand, the financial services sector may face a slowdown due to anticipated interest rate cuts linked to falling inflation rate. E. The ICT sector is likely to benefit from reduced foreign exchange pressure and increased revenue from the tariff hike. Thank you for listening. Please join us same time next week for another interesting and insightful session. For questions, comments, and feedback, kindly forward to ebo.ayodeji@gmail.com or send an SMS to 070-8246-3747. Stay blessed.